The second financial statement that we want to look at is the cash flow statement. So it records how much money is moving in and out of a company or business. So it measures the actual movement of money in and out. So there are three cash flow statements. First is the cash flow from operations, then we have cash flow from investing, and then lastly we have cash flow from financing. So it measures the movement of cash from three different aspects. Firstly, we look at the cash flow from operations. To start with, we are adding in the net income, which is 380 million, and this 380 million is the net income from the income statement example that we have shown previously. We need to make some adjustments to reconcile the net income generated by the business. First of all, we look at depreciation, 50 million in this example. So depreciation is added back to adjust the net income as no cash is involved. So what does this mean? So if you bought a machine 10 years ago and the machine at that time was worth 10 million, so you have to expense it off 1 million over a period of 10 years. So that 1 million depreciation is recorded as an expense in the income statement, but because no cash is involved when you depreciate a machine, so then you have to add back into the cash flow from operations statement. So this 50 million is that you recorded 50 million as an expense in income statement, but you are adding back 50 million in cash here because you have not spent a single cent to depreciate it technically. We also need to make some adjustments for deferred income. So in this example, 25 million is not recognized as an income yet, but we have already received the cash. So there are some instances where a customer pays you or gives you the cash upfront, but it is not invoiced or it's not delivered, the goods and services, so it's not recognized as an income yet. So for this instance, we have received the cash, but we have not recorded it in the income statement, so you have to add back the cash into this cash flow from operations. Some changes in operating assets and liabilities, like accounts receivable. We have delivered the goods, but we have not received the cash, so we have to take off 16 million here. Inventories, we have produced the goods, but we have not sold nor received the cash, so the 23 million is sitting in the warehouse. So yeah, you have to deduct that off because you have already used the cash to produce that inventory. We then have accounts payable of 18 million. So we add this back into the cash flow from operations statement. So these are goods and services that we have used from our supplier, but we have not paid. So the 18 million in cash is still with us. So we record that into our cash flow statement because the money has not moved out. And then we have other current and non-current assets. Say for instance, cash that is used for purchasing assets. So we have already used the money, we have used the physical cash, so we have to deduct it off. Or other current and non-current liabilities. In this instance, 29 million, which is cash owed, but we kept it in the company. So we have not physically transferred the cash out yet. So then we will come to a grand summary. Cash generated from operating activities, 428 million. So if it's positive, net cash generated, which means that you have inflow of cash into the business. If it's negative, which means that you have a net cash outflow, which means that you are burning more cash than you are receiving when running the business. So I like to say that this is one of the more interesting or the most important one that I look at, because for any business operations, you want to make sure that you are cash flow positive. Because if you are spending all your physical cash but you're not receiving it, how are you going to possibly sustain the business in the long term? How are you going to take the cash to pay your suppliers, to pay your rent, to pay salaries to your staff? Yes, so very important, cash generated from operating activities has to be positive. Second cash flow statement is the cash flow from investing activities. So for any businesses or companies, you would spend money to buy new equipment or you would get some money from selling a certain plot of land or an old equipment that you do not want anymore. So in this example, purchase of property and equipment, the company has bought new equipment for 200 million, so 200 million of cash is physically moved out of the company. So for instance, on the second row, you have sold an old machine and you have gained 25 million. So then you record 25 million coming in to the company. So for some companies, they do purchase marketable securities like stocks or bonds, for instance. So when you buy these bonds or stocks, you need to record a negative outflow of cash to buy these securities. In another example, the fourth row, maturities and sales of marketable securities of 60 million. So when you sell that stock or bond in the future, whether you make a profit or not, there will be a cash value there. And when you receive the cash, you record it into the cash flow from investing activities as a positive inflow. If you look at the last row for acquisitions, when you are acquiring a company, you need to pay that company the money to buy the shares. So there will be a negative outflow of money when you use the cash to acquire a company. So in this example, cash generated from investing activities is negative 250 million. So it's not right or wrong, good or bad. But what this means is that if it's positive, the company is selling assets. If it's negative, the company are buying assets. So when the company buys asset, it sort of means that they are going through an expansion or a growth stage in some ways if they do purchase more equipment. But sometimes, it could be blinded that the companies spend a lot of money in investing in marketable securities, for instance. That can be a red flag if the nature of the business is selling fruits and you're spending all your cash into buying stocks. So that is weird, right? But no right or wrong. If it's positive, the company is selling assets. If negative, the company is buying assets. The last cash flow statement is cash flow from financing activities. So most businesses or companies has some sort of financing options that they take up to finance or run and operate their business. So there are a few examples. Let's look at repurchases of capital stock, for instance. So you have heard that there is stock buybacks in the public from the company. So this happens when the company decides to repurchase stocks. So when you repurchase the stocks, there is an outflow of money. So you record it as a negative 125 million in this example. Some companies issues bonds or debts. So when you get the proceeds from the debts or bonds issuance, you will get an inflow of cash from the debt holders or the debt investors. And another example we can look at is repayment of debts. So for instance, when you issue a bond, there is of course a yield or a coupon that you need to pay to the investors. So when you pay the investors that yield or coupon, then you need to record this as a negative outflow. So in this example, cash generated from investing activities is 20 million. And what does this mean? If the value is positive, the company is borrowing or raising money or selling shares as a way to generate funds to operate and run their business. If cash generated from investing activities is negative, this means the company is clearing off its loans, its debts, or it's actively buying back shares.